Ladies and gentlemen, we welcome you to this Jeju City, the most beautiful and charming city of Korea, and this historic moment of the inaugural and the first Global Financial Consumer Forum and the annual conference of the International Academy of Financial Consumers. Over 70 participants throughout the world, academics and regulators, practitioners, interested in protection of the financial consumers gathered here in Jeju City together here. And with that remark, let me introduce Dr. Hong-Ju Jung, the host of today's event and chairperson of the board of directors and president of IAFICO, the dean of SKKU Graduate School of Insurance, and also worked on PhD in insurance.
Good morning, ladies and gentlemen. My distinguished guests. I warmly welcome all of you to IAFICO 2015 conference. We have prepared this conference over a year since we had the first meeting 2014 December at SKKU. This conference and IAFICO is created for the sake of the consumer protection, financial consumer research and the protection activities from the academic domain. And we have succeeded in getting about 80 participants from across the country. And we are going to devote our academic activities on the policy research and academic research and the best practice research for the future. And for this conference, there was many friends and colleagues to contribute to the opening of this ceremony. Especially, I would like to name a few very precious colleagues of mine. Number one is the Professor Kim Jung-soo from Jeju University, who was very generous and sacrificed herself to provide us these nice facilities. This facility has never been open during the weekend. Although this building is less than 5 years old, this building has been only open during weekdays, but we have a privilege to getting this facility which is Saturday and Sunday. So a special thanks to go to Professor Kim Jung-soo. She is up there. Why don't you give a big hand to her? And I also thank to Professor Sharon Tennyson from Korea University. She's still coming from the ㅡPresentation area, this conference center. She's coming soon. And all the other board members, board of director members in our community, including Professor Satoshi Nakaite and Lee-Hong-mo, Seung-Han, and Joyce Chen from Taiwan, and the other board members. I thank you very much. And from now on, we will begin our 2015 conference. Please enjoy your staying here and attending the conference. Thank you very much.
Okay, thank you for the statement. And next, I would like to give the floor to Dr. Bong Ha-ji, who is the Dean of Handong University Business School and a president of Financial Planning Association in Korea, and also a PhD from Wharton Insurance Department.
Good morning. First, let me apologize for my appearance. just. But to Koreans, it comes to Jeju Island, so it sounds more like kind of relaxing, refreshing, and a moment, rather than more uptight and cosmopolitan, very busy, and activity-oriented lifestyle. So it's quite an honor for me to be invited to congratulate on the opening of Global Financial Forum organized by International Academy for Financial Consumers. When I heard the last year of the establishment of International Academy for Financial Consumers, I was very pleased because I thought it was a very opportune time. As you know, watching those trends in the last decades or so, all those on social development and economic growth and demographic change. So we understand the importance of studying the behavior of financial consumers and then find out the way to meet their needs through products and then also financial services, the industry, and then issues of how to protect their interest. So it's very important for all people of the interest to work together for such research and sharing their ideas and exchange information. So that's why I thought it was the right time and opportune time for us to collaborate through this platform of International Academy for Financial Consumers. So, and to establish it, I'd like to comment and also congratulate on the leadership of Hong-Ju Lee in this regard. So many of you know he's quite a visionary man who can capture at the right moment and with very good eye of understanding the trend. So through his leadership, so we have this opportunity to share, to encourage each other and build up this podium for the academic activities by the people who are interested in the consumers. So I hope for the development and future growth of this organization and have productive discussion, and also like the friendship by all people of the same interest in Jeju Island. That's I understand why we decided to have the annual meeting and global forum in Jeju Island. So I hope you have a productive meeting for the next couple of days and enjoy this refreshing moment on the Jeju Island. Okay, thank you very much.
Okay, our next speaker on the list actually is Dr. Seung-Han from Cornell University, and as Hong-Ju announced, she is still on the way. So hopefully we will see her and hear her congratulatory remark later in this conference. So instead, actually, we have two more congratulatory remarks from Jae-Yoon and Jae Kim, which is included in these proceedings you can find. Unfortunately, they couldn't attend today's meeting and sent us these letters instead. Jae-Yoon is the former chairperson of International Financial Action Task Force and an immediate past chairperson of Financial Supervision Committee of Korea. And Jae Kim is a chairperson of Consumers Korea. Their messages can be found in these proceedings, and Dr. Hong Jung also asked me to read through these remarks, so I will go ahead and try. Okay, so let's see. So on the behalf of Jae-Yoon, I will read it through. I sincerely congratulate the International Academy of Financial Consumers on opening its 2015 annual meeting on the beautiful Jeju Island, which with its cherished blue skies of October. The global financial crisis in 2008 brought about major changes in the global financial paradigm. Although there have been various changes, I would like to talk about the three biggest changes amongst these. The first is the strengthening of the health of representative financial companies due to Basel III and the ending of too big to fail, etc. The second is the strengthening of financial consumer protection in order to prevent the unsound practices of financial companies from such as labor rate manipulation and subprime abusive sales. The third is the strengthening of regulations to prevent money laundering and terrorist financing. The main issues of this paradigm shift have been discussed in depth as an area of concern at the G20 summit since the financial crisis of 2008. In particular, the emergence of financial consumer protection issues means that there has already been a shift in the vision of policymakers, academia, and the business world, etc., regarding finance from the suppliers, the financial companies, to financial consumers being the central axis. Accordingly, today at this IAFICO event, I would like to mention a few matters regarding the issues of financial consumers that we should be taking an interest in. The first is to improve the financial literacy of financial consumers. Financial literacy is a vital infrastructure for reducing the information gap between suppliers of financial products and consumers, and strengthening consumers' choice, which needs to be achieved through systematic and ongoing education. Financial literacy is not only important to individual consumers by the prevention of financial accidents and the accumulation of wealth through financial transactions, etc. But the higher the financial literacy of financial consumers, the more they will be able to catch out the incorrect behavior of financial companies, etc. Thus, strengthening market discipline and minimizing damage should another financial crisis occur. Secondly, is to systematically establish a pre-post financial consumer protection system to prevent harm to financial consumers and to strengthen the system in the case of any harm. After the need was established to lay down a standard for the protection of financial consumers at the 2010 G20 Seoul. summit at international institutions such as OECD, there was much progress such as financial consumer protection principles and action plans being drawn up. However, much more effort is still needed for this to take root in the financial systems of individual countries. Thirdly, is to expand the financial inclusion of classes and regions unable to properly take advantage of even the basics of finance, such as remittances and deposits. There are issues related to the problems with the basics of finance, such as sorry about this. Financial intermediation functions played a key role in the growth of the global economy since the Industrial Revolution. The strengthening of financial inclusion for underdeveloped countries and low-income families could ultimately not only improve their lives, but is also individually linked to the regional national growth, therefore is a matter that requires a sustained effort. These issues relating to financial consumers require sustained and systematic research and discussion in the future. Not only in one country, but on the global level, experts related to academia, financial authorities, and the financial sector should cooperate to find, share, and develop best practices. In this sense, the IAFICO annual meeting will be a great opportunity for such international cooperation. At this meeting, through deep and lively discussion, I look forward to drawing constructive and productive strategies and alternatives regarding the issue facing financial consumers. Okay, while I was reading it through, I believe that Dr. Sharon Tennyson finally came here. Okay, so we will. Let me introduce Dr. Sharon Tennyson, who is a professor of Cornell University and also an editor of the Journal of Consumer Affairs and a PhD from Northwestern University. Dr. Sharon Tennyson, please come up front.
Good morning, everyone. This is what I get for being late, right? I apologize. I'm a little disoriented, not because I've just arrived in Korea, perhaps because it's time for me to go home soon. I've actually been here for about 10 days, first leading a student field trip from Cornell, and then doing some discussions with other universities here on behalf of Cornell. And I've just spent a day and a half here on Jeju Island recovering from all of that before launching into this next event, which is a very interesting conference that I'm looking forward to. I recall meeting Professor Hong Ju-jung in 2010 at a conference in China. And I've been very interested since that time to follow his efforts to develop academic programs, to promote academic interest and public policy interest in financial consumers and financial consumer protection. In this pursuit, I feel we are kindred spirits, although I'm much shyer than he is, and so I'm very grateful that he seems to be very talented at seeking out, perhaps even creating, and bringing together other kindred spirits around these topics of study. And thus it's wonderful that we are all here today, that I can be here today among so many kindred spirits at the 2015 Global Forum of the International Academy of Financial Consumers. I want to congratulate the Academy and all of its founding members and the organizing committee of the 2015 conference for successfully gathering such a diverse and international group of participants. I know that I can safely say, on behalf of all of us attending from abroad, that we are very excited to learn more about the Academy, its members, its research and policy agenda, and that we look forward to the sharing of knowledge during this forum on beautiful Jeju Island. And finally, we look forward to the long-lasting relationships and future collaborations that I'm sure will come from this conference. Thank you in advance for organizing this event. Thank you in advance for Jeju Island. I know everyone here is going to enjoy the location as well as the discussions and the conference venue. Thank you very much.
Of today. So now we are starting the opening plenary session 1, which is expected to decorate our first day. This session will be moderated by Dr. Man Jo, who is a from KDI School in Singapore National University and also an editor of the IAFICO journal and who received a PhD degree from Wharton's Business and Public Policy. So, Dr. Man Jo, it's your turn to lead this opening session. Thank you.
Okay. Thank you for the introduction. This is Man Jo, and I'm teaching the risk management and real estate finance courses in my school. But the origination of my trip to Jeju Island this time was not from Seoul, but from Singapore. So I'm spending my sabbatical leave in National University of Singapore. But I was recruited by Hongju, so I had to come over here. I have to say that it is my honor to chair the first plenary session. And the title of the first session is the Consumer Protection in Loan Market. So before I go into the session materials, I want to recognize the effort and leadership of Hongju Chung. And if some of you sent an email to him, you might have noticed that his email address is Jungpro, Jung Pro. So that means he's a professional in creating a academic association. So he has already done a very successful Consumer Finance Academic Association in Korea. So now he's doing it globally. So I wish all the best for his effort. Now getting back to the plenary session, we have 2 papers and 2 discussions. And so we have a relatively flexible time that we can allocate. So each presenter will spend up to 30 minutes and the discussant 10 minutes. Then in the end, if we have some time, we'll have a floor discussion, okay? Then I prepared a 1-page slide to put the 2 papers to be presented in perspective. The reason that we gather here this morning is that we want to promote something, but at the same time, we want to demote something else by collecting our heads on the consumer finance issues in the financial market. So, for example, we want to enhance financial literacy, but at the same time, we want to reduce fraudulent or mis-selling in the financial markets. And today and tomorrow, we will hear various presentations in different angles on these issues. We also have regulatory issues. We want to have effective supervision for a number of things. And then for this conference as well as association, we want to increase the information sharing, cross-border information sharing, new ideas as well as best practices. I think that's why we are here. Then last but not least, the item about financial inclusion and fair risk sharing. That's what this session is all about, especially in the lending side. So the first paper to be presented by Professor Seung-Han from Konkuk University is about non-recourse mortgage lending in Korea. So this is what both Hongju and I were involved. It's a government-sponsored research project that we did earlier this year. And Korean government is trying to have more fair division of risk sharing between lenders and borrowers. So they introduced this concept of non-recourse loan, which gets some publicity after the global financial crisis. So my colleague, Professor Robb, will share some of our research findings. The second paper to be presented by Professor Clifford Robb of Kansas State University is about the role of financial knowledge, how savvy the financial consumers are in two particular lending market segments. That is the students' credit card loans and payday loan markets. So that's the short introduction that I want to give about the two papers in this session. And with that, I will turn it over to our first presenter, Professor Robb.
Hello, thank you for your kind introduction, Dr. Jo. So, as he introduced, my name is Seung-Han from Konkuk University. What I'm going to present today is the non-recourse mortgage in South Korea, risk and opportunity. So, the co-author of this paper is the Yong-man Lee from Hansung University, and Seung-dong Yu and Sangmyeong University, and Man Cho, the Canadian schools, our moderator, and Hongju Jeong from Seung-Han University. Actually, even if I have been studying the real estate finance, I have not thought about the academic area as a financial consumer. So before I involved in this project, so I fortunately Dr. Jeong let us know this financial consumer conferences. I'm very glad to present this paper at this conference. Okay, so this is agenda that I'm going to present today. So introduction, literature, data, methodology, result, and conclusion. First of all, so I'm going to talk about the mortgage. So that's why we need to figure out the definition of mortgage. Mortgage is a debt instrument secured by the collateral of specified real estate property, then the borrower is obliged to pay back with the predetermined set of payment, as you know. And definitely, so mortgage lender is a financial institution, while mortgage borrower is a real property buyer as well as a financial consumer. And then there are several issues and classification regarding mortgages. So this study is focusing on the issue of what's going to happen in case of the mortgage default. So especially, so whether or not some mortgage lender allowed to collect the mortgage residual balance beyond the value of the collateral property. So we can classify them too, so recourse loan or the non-recourse loan. As it says, the recourse loan, in case of default, the type of loan that allows the lender to go after the borrower asset that were not used as a loan collateral if the value of the underlying asset is not enough to cover the residual loan balance. However, non-recourse loan is opposite. In case of default, a type of loan that allows the lender to seize the collateral but cannot seek out the borrower for any further compensation even if the collateral does not cover the full value of the defaulted amount. So recently, the South Korea government, the Ministry of Land Infrastructure and Transportation, so announced a plan to introduce the pilot non-recourse mortgage program. They announced this pilot non-recourse mortgage program is expected to activate in December 2015, and this government expects the non-recourse mortgage protects the right of financial consumer and enhance the responsibility of financial institutions. So this one is one of our very important motivation of this study. So we suggest the three purposes of this study. So we try to review the argument point of non-recourse mortgage from the positive and negative aspect. And we investigate the risk of the non-recourse mortgage in South Korea mortgage market, and we try to examine how to share the risk of the non-recourse mortgage between mortgage borrower and lender. Okay, literature. First of all, we try to overview the other countries about the mere habit by the financial institutions are more efficient to manage the risk of the house price volatility because they have the specialty in this area and they have more experience comparing to the borrower. The collection of recourse mortgage is difficult to be bent on gain, so when non-recourse mortgage require the financial institution to take the default risk more carefully, which strengthens the social trust. So, if we make a summary, these are the positive aspects of non-recourse mortgage. First one is the non-recourse mortgage protect the financial consumer. It is close to it had to close to make the social to enable consolidation net. It reduced the probability of credit default and raised the chance of recovery. It lowers the social security cost. It presents the mortgage borrower with the peace of mind. It's a very important part of the financial consumer. And then second, so non-recourse mortgage enhances the responsibility of financial institutions. It may lead the financial institutions to strengthen the ability to evaluate the collateral property. It also induced the financial institution to suppress issuing the risky loan. And then, the non-recourse mortgage also enhances the social welfare. Financial institutions are more efficient to manage the risk of the house price volatility due to their specialty and experience. And others reduce the period and cost of managing non-performing loan and enhance the trust and social capital. However, the non-recourse mortgage still has the risk, the negative side. It may increase the strategic default when housing price significantly fall. So it may raise the instability of the housing and capital market. So the prior literature suggests these solutions. They need to control the loan to value under a certain level. Second, so non-recourse mortgage enhance the demand of mortgage and may it results in bubbles in housing price. It creates a larger housing bubble during an economic expansion, steeper decline in housing price during the economic recession. So, literature suggests the solutions. Let financial institutions tend to be more conservative and provide a risk premium to the mortgage interest, definitely. And then the negative side of non-recourse mortgage is less motivation to manage the collateral property due to the possibility of the strategic default. So, to investigate our research proposal, we employ several data and then some methodology. This is the information. So we employ this expected loss equation developed by the Basel. So to calculate the expected loss is going to be probability of default, the PD, times the loss given default, which is the LGD, times the exposure at default, EAD. So in order for economic evaluation of a new non-recourse mortgage system, the risk, and we need to estimate the value in terms of the two different ways. First one is we tend to assume EAD as a unity, and also we estimate the expected loss rate equal the PD times the LGD. And two approaches and data. The first one is we try to estimate of the expected loss. To make it, we employ the first one with we employ the probability of default. We use the data, the Korean mortgage market data from the financial supervisor survey, the data period from 2007 to 2014, and loss given default. So actually, we employ the prior literature evidence. So previous research such as Park and Bang that studies LGD during the period of financial turbulence in South Korea since 2006 to 2009. So they suggest the recovery rate based on the industry experience. And then probability of default can be a function of the mortgage system. So Guan Kudra finds the borrower 30% more likely to default in non-recourse state. Because the South Korea has not experienced the non-recourse mortgage, so we cannot collect the direct information of this part. So we make a simulation to estimate all these things. The second approach is the myopic approach. National Housing Fund is the direct loss data from 2004 to 2008. Okay, so this diagram shows the procedure for expected loss estimation. So first of all, we collect the historical default data in the Korean market, and then based on we employ the Monte Carlo simulation to estimate it, and then we also employ the existing research as LGD estimation. So based on these two information, we calculate the maximum expected loss, and then we also estimate the maximum economic cost. Because we do not have the macro data available, so we adopt very cautious approach. The historical default rate for the National Housing Fund lower than those for General Bank, and then we employ the data during the period of global financial crisis, and then we assume all the loss would be recovered. this is the result of the default rate, the value at risk using a Monte Carlo simulation. So we assume, we try to test both the symmetric and then non-symmetric distribution assumption. And then we employ the Gantt and Kutra, 32% more likely defaulting non-recourse state. And then as you can see, the result shows the default rate based on the Monte Carlo simulation non-symmetric distribution. So average is the 0.5 to 7, and then 95% is the 0.7 to 9, 99%, and 0.8. However, so if we assume, if we add the 32% more defaulting non-recourse program, so the average is around 0.7, and then it's significantly increased and over 99% value at risk. It is the 1.077. And then we estimate the loss given default. The prior information provides the condominium, the loss given default is 6.18% and house is 7.92%. So the mortgage in the first lien condition from 2006 to 2009, so we analyzed this mortgage from the National Housing Fund in South Korea. And then we also employed the information from Park and Farm. And then we estimate the maximum economic cost with the new loan recourse system. So all the losses will be recovered by the current recourse system, we assume. And then even in the current systems, the lenders have financial damage from mortgage default. And then so this is the equation to make the maximum economic cost. And then the one point is that we assume is the recovery cost rate around 15% is based on the industry practice. Okay, so this table shows the result of expected loss and expected cost. The unit is the base point BPS. So maximum expected loss, and if we assume some no recovery cost, the condominium is 4.0 and house is 5.51. But if we assume there will be the 15% the recovery cost decrease, the condominium will be the 3.66 and house is the 4.69. And based on this information, so if we analyze the economic cost for the National Housing Fund, so market data, the average is the 3.66. And then if we assume some 99% value at risk increase to 5.66. So under the assumption, default rate are higher for non-recourse mortgage by 32%, and all the losses would be covered, and recovery cost is the 15%. So as you can see, based on our simulations, the number of the economic cost, the expected loss and expected cost is hard to say, very significantly high, but we still need to manage the risk of the non-recourse mortgage. So, conclusion. So there are needs the non-recourse mortgage in South Korea. So I will talk about all these things, the positive side of the non-recourse mortgage. And then, so the main point is how to manage the risk of non-recourse mortgage. So we suggest several things to introduce the non-recourse mortgage in South Korea. So first one is we need to make a restricted non-recourse mortgage. Non-recourse mortgage should be lent to a loan-occupied house buyer with low-income household. So very limited part of our consumer. And in pilot program, so borrower of housing and urban government fund meet this condition. And then we also suggest there should be restricted the loan value and risk premium that reduce the moral hazard. And second suggestion is we need to make some specific structure of the non-recourse mortgage about this issue. So the first case is the United States. The United States has a non-recourse mortgage program, but some people regard United States as a non-recourse mortgage country. But if you check the history of the mortgage in the United States, before the Great Depression in 1929, the U.S. does not have non-recourse program. However, so after the Great Depression, the government realized the people feel very painful to recover the debt coming from this mortgage because of the value of the property significantly decreased. So that's why the U.S. government try to introduce and make the non-recourse mortgage program. If you check the literature, United States has the 10 or 15 states has the non-recourse program, such as the Arkansas, Arizona, California, Connecticut, etc. And then these states prohibit to claim deficiency judgment. To classify if any country or state is recourse or non-recourse, you need to check if that country has the deficiency judgment. Deficiency judgment is a judgment levied against the borrower personally for the difference between the mortgage debt and the liquidation value of the property. So, if any state prohibits to claim deficiency judgment, we classify them as a non-recourse state, but otherwise we classify them as a recourse mortgage state. So the others, the 35 to 40 states in the United States, we can classify as recourse mortgage state. However, because they are allowed to claim the deficiency judgment, however, they prefer the short sale and deed rule of foreclosure. So if I give you some definition of them, the short sale is the lender and borrower decide the selling the property and serving a moderate losses preferable to having the borrower default on the loan. And deed in lieu of foreclosure is potential option taken by a borrower to avoid foreclosure under which the borrower deeds the collateral property back to the lender. So, short sale deed in lieu of foreclosure, so we cannot say it is directly the non-recourse loan, but it's part of support system of the recourse mortgage. Because this short sale and deed in lieu of foreclosure provide option to make a deal to release the debt between the lender and borrower. In addition, some FHA, VA, or mortgages issued by public mortgage corporates such as Fannie, Freddie Mac, and Ginnie Mae are non-recourse regardless of any state in the United States. If you check the other countries, the Canada case, so Canada is the recourse country, recourse mortgage country, but some states, including Alberta, have the non-recourse mortgage program. Then if you check the other European countries, mortgage loans are recourse obligation in most European countries. However, so these European countries also realize the people are very painful after the subprime mortgage crisis issue. So they provide some program close to non-recourse. The good example in Spain is the Datio in Soluton, and France and Ireland. So those European countries try to make the non-recourse program. However, so it's not very popular so far, and then their condition is a little bit very strict. There are several issues in non-recourse mortgage. There are several arguments. The first argument from the perspective of financial market stability. The question is, do non-recourse mortgage lead to increase in strategic default? So if you build based on our review, the prior literature find evidence to support this question and as well as the evidence to oppose this question. If you check the support side, so Gantt and Kudra find borrower are 30% more likely defaulting non-recourse state. And then Usual et al. Find 26% of existing default are strategic default. So they are warning the non-recourse mortgage system may increase the strategic default. However, so if you check the evidence to oppose it, the Foot and Gerardi and Willand find the fewer than 10% of negative equity owners eventually lost their home to foreclosure. So negative equity, as you know, so means that the mortgage loan balance is less than the value, mortgage loan balance is higher than the value of the collateral property. And then Buta, Doko, and Shan find median borrower does not strategically default until equity falls to minus 62% of their home's value. So even if they experience the negative equity position of the mortgage, but they still have the potential to increase the value. So pretty much it depends on the economic situation. And then Lee and Oswald, they find the deficiency law changes state. In the United States, after the subprime mortgages in late 2000, several states changed their position. They used to be some recourse mortgage program state, but after the subprime mortgages, they changed it to the non-recourse. So these studies investigate what's the difference between before and after this deficiency law change. And then they find they couldn't find some accepted mortgage default increase in house foreclosure outcome. And Bittman, Harris, and Meyer, the overall default rate have not in fact been meaningfully higher in non-recourse state. So still very argument situation. And then another question under this argument, the question is, does non-recourse law result in larger bubbles in housing price? It is also still argument. The support side, Nam and O find a state with the non-recourse law creates a larger housing bubble during an economic expansion, and then they experience a steeper decline in housing prices during an economic recession. Bao and Ding find non-recourse state experience faster price growth during the boom period and sharper price drop during the bust period. So these two papers pointed out the non-recourse mortgage system is the provides the motivation to people make a boom to buy the house and make them sell the house. However, the opposite side, Mian and Sufe find overall the liquidity could cause a housing market bubble. They analyzed this housing market bubble in the United States is not because of the recourse or non-recourse, but they think the over-liquidity issue of the mortgage market is the main reason for that. Lee and Oswald also find some deficiency law change in Nevada contribute negatively and statistically significantly to lenders' approval rate as well as mortgage loan size of approval. Castilla, the generation of recourse mortgage has been a major booster of Spanish real estate bubble. The second argument from the perspective of the protecting the financial consumer, the question is, does non-recourse mortgage protect the financial consumer? The prior literature said the availability and use of the personal bankruptcy and document solution of mortgage as legal solution to problem of over-indebtedness faced by a number of consumers in the European country. And then in Japan, the Non-Recourse Mortgage Development Association announced the personal bankruptcy requires more social cost and non-recourse mortgage raise the chance of recovery. And then, so in the United States, the home operables, the foreclosure alternative program, provide homeowners the opportunity to exit their home and be relieved of their remaining mortgage debt through a short sale and deed in lieu of foreclosure. So they pretty much support this idea. And another question under this argument is, does non-recourse mortgage enhance the responsibility of financial institutions? So Korean government is pretty much point out this positive aspect of the non-recourse mortgage. So Lee and Oswald again, they check the deficiency law changes state, such as the Nevada. They find that after this law changes, the financial institution can be more conservative to issue the mortgage, and then they more strictly underwrite the mortgage. And Castilla and Nixon, they would be more cautious in the release of credit, rejecting overly optimistic valuation of the real estate collateral. So, last argument is the argument from perspective of enhancing the social welfare. It is also the positive aspect of non-recourse mortgage. The question is, does non-recourse mortgage enhance social welfare? So Mitman finds comparing the bankruptcy of mortgage default and credit default, the non-recourse mortgage reduce overall the bankruptcy. It makes the cost clauses in mortgage contract to protect the non-recourse mortgage lender. In case of fraud, the example, in case of fraud and fake documentation, so non-recourse does not validate. And then if there is vandalism, the non-recourse does not validate. And then structure of the non-recourse mortgage should have the borrower to have insurance to compensate the loss of the non-recourse mortgage. Could be the partial and total insurance and credit insurance or guarantee insurance. We need to additional the investigation for this part. Okay, thanks for your attention.
Okay, thank you for the detailed presentation. And the discussion of the first paper will be by Professor Jing Ai from University of Hawaii.
Sorry, I tried this before and double click on it seems to be problematic. It shows up. Yeah.
I'll just stay here and talk about it.
Because I
only have a few slides here. So, well, thank you first very much for the opportunity to discuss this very interesting paper. It goes without saying that it's a very important topic and both have important business implications, but also policy relevance. So, my first slide here actually is just a quick summary, which I thought the presenting professor has done an excellent job kind of summarizing what they have done. But just very quickly to refresh your memory, what this paper has proposed is an economic analysis of the non-recourse consumer loan safer, but I guess nothing is, we have to do really good risk management. I guess I should have it in both versions. Anyhow, so as I was saying, this is just a quick summary from my read of the slides that were made available to me beforehand. So essentially this paper presents the economic analysis of a proposed non-recourse mortgage loan system in South Korea. And I thought the authors did a great job sort of presenting a cross-country comparisons of the current status of non-recourse versus recourse mortgages in different countries around the globe. And they did a very nice job presenting a detailed discussion of the pros and cons of non-recourse mortgage loans versus recourse mortgage loans. Since the presentation was very detailed, so I thought I'd save us some time not to rehash what the professor has already talked about. So the second part of the presentation, as we just heard about, is an empirical estimation of the expected loss and the expected cost under this new proposed non-recourse mortgage loan program using historical data from Korea. So just a quick refresher of their estimation model. So essentially there are two components that go into the expected loss estimation. So the first component is the probability of default, which was estimated based on historical default data from the sample period 2007 to 2014. Of course, the historical data was based on a recourse loan program, so they adjusted the historical default rate by allowing an increased rate of around 30%, just to take into account possible strategic default and other factors that may have increased the default rate under the new non-recourse mortgage loan program. The second component of this expected loss estimation is loss given default. And as the presenting professor has mentioned, so they took from existing literature, fairly recent literature, and to do their estimation. So the expected loss then is the product of the probability of default times loss given default. So from there, they estimated this maximum expected loss by taking into account a recovery rate assumption. So currently, they're assuming 100% recovery rate, and they also calculate a maximum expected cost, which is essentially the maximum expected loss times a recovery cost that the bank will incur, and I think the assumption is about 15%. Okay, so here are some of my questions and comments. So as I said, I thought this is a great paper, very good introduction, as well as a good summary of the empirical estimation results. So my first comment here is I'm not sure if the 100% recovery rate is a good assumption for the paper. I understand the authors was trying to come up with a conservative estimate so that they could compare with the current system, which is the recourse mortgage loan program. And they found that under the set of conservative assumptions, the estimated cost actually is a little higher than the current program. Nonetheless, they still, of course, take into account the pros of the non-recourse mortgage loan program recommend to have this reform. But I was thinking, since our goal is to try to, compare it to the current recourse mortgage loan system, maybe one of the things could be to use a set of different assumptions of recovery rate, right? So not to just settle on the most conservative estimate, which is actually arguing against the non-recourse program a little bit. But that was, in my opinion, maybe too conservative, along with other assumptions. So maybe we can think of like a set of, sensitivity analysis, stress testing, however you call it. So my second couple comments are on the estimation of probability of default. So as far as I can tell, I think the same probability of default was assumed for condos versus houses, and also owner-occupied versus investment properties. So if strategic default is something that we're concerned with, then I think there's reason to believe these probability of default may be different for different types of properties, thinking about what are the types of people who tend to, say, purchase condos versus purchase houses, sort of in the same line as how credit scoring take into account certain factors like demographic factors or behavior factors, right? Maybe we can, maybe, I don't know, I don't know about the empirical data, but maybe I would imagine a slightly higher maybe probability of default, especially taking into account strategic default for condos, maybe since those are more for like single, younger people who tend to be maybe less responsible financially. I'm not sure. I was just thinking maybe it's worth exploring, either looking at the historical data or just looking at different sets of assumptions. I think it's probably more true for owner-occupied versus investment properties. A lot of the arguments presented for financial consumers not to strategically default is to, I think, essentially saying that they don't want to give up their homes, right, just to game the system. But I think it's probably more true for the for the owner-occupied. Like I'm not gonna give up my house because I live in it. But if it's just like some property that I invested in, like in Hawaii, there are buildings and buildings of condominiums that are half empty because all of these are international investors who were never there. So I think these investors might be more leaning towards strategically default under the new system. Just another possibility to think about. And also the sample period, it covers this rather very recent but also different kind of I guess not so representative period, which covers the financial crisis period. Again, I understand and I agree with our authors that their assumptions are conservative by covering the financial crisis period because we don't expect quite as many default events outside of this period. But again, since we are trying to make an estimation or kind of a prediction for what would happen in this new system, I would recommend using a more representative period of time, just because we're not going to expect financial crisis, in a normal long period of stretch of time. So lastly, just about the value at risk calculation. So of course, value at risk is a very good way to give some tail estimation to look at, what would the maximum expected loss and cost to be at the tail of the distribution. But it seems to me that, I just sort of based on the numbers available in the slides that were sort of calculated myself, seems to me that the value at risk calculations were also shifted kind of along the x-axis, just like the mean, by about 32%. So that's a implicit assumption of saying variance and higher moments don't change after this new system. After the new system is implemented, which I'm not exactly sure. Like think about the tail behavior. Those people who used to default, are we expecting they exhibit the same type of default behavior or pattern under new system, or are we expecting maybe a higher variance or maybe a fatter tail? So I thought maybe some work can be done in that area as well. So these are just some of my comments. Thank you very much.
Thank you for the very thorough comments. The second paper in this session is by Professor Clifford Robb from Kansas State University.
For having me. I think in terms of my communications in deciding to come here and looking at being at the conference, it was a little bit of misunderstanding on my part, so this is going to be a little bit less formally structured as a single paper. This is really a compilation of a few papers I've worked on in dealing with how consumers operate within credit markets. And so the first little discussion will be focusing on college students, and it will specifically focus on credit card use by college students. But I'm going to kind of go ahead and lead in with that data it's a little bit dated now. We have to get to the fact that since the research I conducted, or since the data I conducted, the United States engaged in much more aggressive credit card legislation. So the CARD Act, which was kind of enacted in 2009, early 2010, has really changed the environment of consumer access to credit cards, particularly among young adults in the United States. So it's not as easy to get a credit card for a college student as it would have been in the early 2000s, mid-2000s, which is around the time that I was really kind of digging into the data. The second paper we're going to discuss looks more at alternative financial services. Alternative financial services in the United States consist of payday loans, auto title loans, any of those kind of really we consider high interest, high risk loans that are available to consumers. And that's going to deal with a broader set of consumers. So it's not just college students, that's dealing with Americans in general. So we'll kind of talk about the progression between the two. So the first thing we need to do is kind of acknowledge the theoretical context in which consumers engage in borrowing decisions, right? So we think about this from a life cycle income consideration. You can choose whether you want to operate under the permanent income hypothesis of Friedman or the life cycle income hypothesis of Hondo and Modigliani. But here we have this notion that consumers face this uneven income reception curve, right? They're going to receive income over the lifetime akin to the blue line here. And theorists have suggested under life cycle economic theories that there is a general desire on the part of consumers to engage in steady consumption throughout the life cycle. So this notion that we'd like to engage in income smoothing. And ideally this can be done by bringing resources from the higher earning periods into the lower income periods, such as retirement and early life. So we can engage in borrowing early on, saving and preparing for later life in the middle stage, and then spending down in our later years. Now there's some complications that obviously arise from this model. Real complications dealing with uncertainty. So as nice as these economic models of life cycle decision making are, from just a purely mathematical and wonderfully economic standpoint, they put some assumptions on our ability to know the life cycle time frame in which we make decisions. So there's an assumption that I know when the end is going to be, and so I can plan accordingly. So I will consume just enough so that maybe at age 85 or 88 or 90, whatever my expectations are, that my life will end then and I will be done with my resource use. That's obviously a difficult thing to assume. It also makes assumptions about my known income path, which can be very difficult for most consumers to engage in that understanding. There's also a lot of assumptions about capital markets being completely equitable, right? So there's this idea that all consumers can borrow against this future expected income at an equal rate, and a fairness is assumed there. And we know that consumers really have access to credit that's quite different. So one consumer's access to credit is going to look different than another consumer's access. And the cost of that credit may be very different. So the cost of borrowing is a huge factor that we have to bring into consideration. And that's really the purpose of these papers, is looking at borrowing that's a little bit more expensive relative to maybe the traditional loans from like a bank or institution. And this also fails to kind of really account for consumer preferences. So there's this notion that some consumers are going to be a little bit more present-oriented than others, and some consumers are going to be a little bit more future-oriented. So there's differentials in the desire for consumption that would play into this model. Now, obviously, these models can be modified. These life cycle models can be adjusted for a lot of these assumptions and can be improved in such a way. But what we really want to get into is the decision of how do we get into what instruments should we be utilizing in this early phase. And so there's a lot of these borrowing decisions are the focus here. So should we be using traditional loans, credit cards, alternative financial services, which are good in a pinch, apparently. So there's this notion that we have to figure out what this optimal borrowing looks like. So when we look at credit cards, hypothetically, these can provide some degree of income smoothing. And when we think about credit cards as an instrument, ideally that notion of income smoothing would be presented in the context of an emergency situation. So there's a notion that these are going to be a little bit more expensive than a traditional borrowing method, such say through a bank or a credit union. And so if I utilize a credit card instrument to smooth income in a period where I don't have enough to meet expenses, it has a high cost. And it also has an immediate cost for the most part, in the sense that there's a minimum monthly payment that kicks in, and a relatively high interest rate in most cases. Sometimes that's an interest rate that's set low for a short time period, but we have to recognize that when we use credit cards for income smoothing, there's a pretty direct cost. There's also a fair amount of research on the notion that credit cards not only provide this needed income smoothing, there's this nice marketing instrument, but they also could potentially send signals to consumers about their asset values that are incorrect. So if a naive consumer looks at their credit card statement and notes the credit card limit that they have available to them, some consumers might view this limit as a real projection of their future earnings path, or a notion that I can afford X number of dollars in lending. And that can be problematic. Consumers are looking at that credit card limit as a signal of how much they can spend, how much they should use the card. That can be problematic. So the purpose of these papers is to really kind of start to explore this literacy discussion. And I'm going to talk about how literacy, I think, is, at least in my research, is becoming a bit of a dated concept. So we're kind of in this idea that I think we need to move beyond just this notion of literacy in a very simple sense. And this early paper is literacy in its most, I think, simple form, in its pure objective knowledge of the consumer. And that is a very limiting measure of literacy of information. So I used a composite measure for this study. This was a series of questions that were asked to a large sample of college students. They were given 6 financial knowledge questions, and those knowledge were measured into kind of a composite measure of objective knowledge. This is a sample question, just to kind of give you a sense for what that kind of looked like. So which of the following credit card users is likely to pay the greatest dollar amount in finance charges per year if they all charge the same amount per year on their cards? And then we have someone who always pays off their credit card bill in full, shortly after receiving it, someone who only pays the minimum amount each month, someone who pays at least the minimum amount each month and more when they have more money, or someone who generally pays their card off in full but occasionally will pay the minimum when they are short on cash, and then the don't know options available. And obviously the correct answer is bolded there in the sense that you should understand that the way credit cards work, how finance charges work, what the greatest amounts are going to be. So the questions themselves are not complex questions, but we find there's a very broad variation in the number of students that get, especially all 6 questions correct. Very few get all 6 questions correct, and many of them miss questions like this. So we get into the empirical model for this study. We looked at 5 separate behaviors using Likert-type scales of whether students strongly agree to strongly disagree, 1 being strongly agree, 5 strongly disagree, of credit card behavior. So 1 is my credit cards are usually at their maximum limit, so whether they're maxing out their cards. 2 is I always pay off my credit cards at the end of each month, so they're being essentially non-revolvers. 3, I often make only the minimum payment, so recognizing that these are our revolvers. 4, I'm seldom delinquent in making payments. And 5, I seldom take cash advances on cards. And so we just used a relatively simple empirical model of credit card use being a factor of this composite knowledge score, several financial factors, and several demographic characteristics. Now, what we found looking at this sample of about 1,300 college students, and we did use multinomial regression because we looked at high, medium, and low risk behavior for the 5 separate models. So each of those models was broken down into, because it was a Likert-type scale, there's kind of a neutral category there. So high, medium, low. And what we're predicting is whether students demonstrate or develop more risky behaviors for each of those 5 models. And the reference knowledge, or the reference category for knowledge was the medium knowledge score. So we're looking at high or low knowledge relative to the medium knowledge in this outcome set. So we found pretty much across the board, as anticipated, knowledge is significant in all 5 of our models. So model 1 was looking at credit cards being held at the maximum limit. Individuals that had high knowledge scores were 42% less likely, and so this is just a simple odds output from a multinomial regression, and 42% less likely to have a credit card at the max. Whereas individuals with a low knowledge score, now remember this is to the median knowledge individuals, so that's where we're going higher or lower than. The low knowledge scores were 106% more likely than those with median levels of knowledge to have a credit card at the maximum limit. Looking at the non-revolvers, we did not see a significant difference between high and median knowledge. But we did see that those with low knowledge scores were 25% less likely to report non-revolving behavior. In the minimum payment domain, sorry, I kind of skipped ahead. The minimum payment domain, we saw, again, consistently, high knowledge individuals were 49% less likely to report making minimum payments on a regular basis. We did not see a significant difference between the low and medium knowledge groups in that case. For the delinquency measure, we saw a pretty good disparity. Again, both high and low were significantly different than median scores. With the high knowledge scores were 56% more likely. Remember, this is reporting being seldom delinquent. So that's an expectation that, yeah, they're less likely to be delinquent if they have a high knowledge score. The low knowledge scores were 55% less likely to report being seldom delinquent, meaning they're more likely to be delinquent. Same with the seldom cash advance. High knowledge scores were 39% more likely to suggest that they were less likely to take cash advances, whereas those with low knowledge scores were 46% here more likely to take a cash advance because they're less likely to report being seldom to do that behavior. Now, I went through this one pretty quickly because I want to kind of highlight some of the limitations of this. This is a little bit older paper, and it was limited in data being just college students. So for one, that's already you kind of got that natural sample that works really well from an academic standpoint, but doesn't always carry over to how far does this work in terms of going beyond that. Knowledge conceptually is very limited. So just looking at this objective knowledge based on a few questions, you can have lots of debate about what's the right way to assess knowledge, what's the correct way to assess literacy. One of those being the question of, well, what are the most appropriate variable questions to ask? So what kinds of knowledge are most important to decision-making processes? So should we have only asked questions about credit cards in this context? Because we ask questions about all different domains of financial decision-making, and all of our behaviors were credit card behaviors. So maybe that's not the most appropriate method of objective knowledge measurement. Second, and this is where I think it gets more interesting, is that objective knowledge itself is a very limiting measure. It doesn't necessarily tell us a whole lot about behavior in every context. And so what we look at when we say literacy, if your definition of literacy is purely objectively looking at objective knowledge, I think you're going to have a limitation in applying and using that. A definition of literacy, I think a more evolving definition of literacy, has to incorporate application of knowledge and behavior associated with knowledge. And so we have to think more about how it's begun to be defined in the United States. You see a lot more papers now starting to deal with financial capability and people's ability to maneuver financial markets, and a lot less about just what they know about markets. Even though it's kind of implied in literacy that literacy is tied to action. We have to have some kind of connection there. So what we really want to do is start to look at objective knowledge, which is kind of what we measured in this study. This previous study was all objective knowledge. What do they know about credit card products and different market instruments? And we want to kind of move into this realm of subjective knowledge, is what do consumers believe they know? Or what is consumers' understanding of their own knowledge? And how does that affect actions? Because that's really a measure of confidence. And when we look at consumer behavior, confidence is a critical precursor to action. If we don't have confidence, even if we have some knowledge, we may not necessarily move on that knowledge or act on that knowledge. So an additional study, and this is a much more recent study. This was fairly recently published in give a plug for the Journal of Consumer Affairs, where Dr. Tennyson is editor of, and I'm currently an associate editor for that journal. But this paper, we use the National Financial Capability Study, which is a much larger data set to work with. This is sponsored by FINRA, which is a regulatory agency in the United States. We used both waves of the state-by-state survey, which is a fairly large sample at the end. Once you pull the samples, you have about 53,000 American citizens from across 50 states to kind of look at this behavior. Now, we can kind of go back a little bit to this notion of what we were working off of. We were kind of looking at borrowing behavior from a rational standpoint of, okay, if people operate under kind of neoclassical economic assumptions that they are fully informed consumers who are making utility maximizing choices among market alternatives, we can determine optimal borrowing. and optimal borrowing oftentimes is defined as the least cost method. So if we look at all the market alternatives, we can find which one's going to be the least expensive option. And we basically start to ask the question, are all borrowers really a reasonable fit for this model? And how well do borrowers fit, and to what degree? So we postulated that some borrowers are potentially making suboptimal decisions in credit markets as a starting point. And we wanted to determine, well, what might be some characteristics of these borrowers that are making the suboptimal choices. And we were working off of a theoretical model of bounded rationality, which is not uncommon if you're familiar with any of the literature on behavioral economics or more economic psychology, and this notion that individual knowledge, which was our key component here, and the ability to draw on that knowledge, the ability to apply that knowledge, are really critical in making decision-making, particularly under uncertainty, like borrowing decisions. So we wanted to look at this notion of how accurate individuals' forecasts are of borrowing decision-making. So when they engage in a borrowing decision, how confident are they in terms of their ability to pay that off? What is their logical process there? And how driven are they by things like optimism and confidence in their borrowing decisions? So here's how we measured financial knowledge, and this is because this is how it's measured in the NFCS. Now again, we're going to note there's some limitations of these questions. These are fairly simple economic questions about basic finance. And I'll give you a hint that Americans and many other countries, compared to the data I've seen, are not fantastic at financial knowledge questions. So we don't score very highly as a country if you look at the United States as a whole on these measures. So this is a very simple question to start. Suppose you had $100 in a savings account, a 2% interest rate per year. After 5 years, how much do you think you have in the account if you just left the money to grow, right? Really basic. Even if you understand simple interest, you can get this question correct. You don't even need to understand compound interest, which is really what this question is about. It's about interest compounding. Because they give you these multiple choice answers of more than 102, exactly 102, or less than 102. So anyone with a mean understanding of simple interest can get this question correct. Unfortunately, still only 77% of respondents in the United States got this correct. So a decent proportion of the population that took this sample, or took this survey, didn't know this question. Question 2 is also relatively simple. It deals with inflation. Imagine interest rates 1%, inflation is 2%. After 1 year, how much you'll be able to buy with this money? More than, the same, or less than. A decent percentage of Americans, again, do not get this question correct. Even though, and these first two questions are really hitting on numeracy, and people's comfort in dealing with numbers and working through them. Question 3 starts to get into more product knowledge. So question 3 says, if interest rates rise, what will typically happen to bond prices? You can argue that most Americans don't necessarily need to know this in any given situation, but it's still not a bad thing to maybe have some awareness of. So here, this is the one that people do really bad on. The notion that if they go, they're going to rise or fall, stay the same, no relationship. Most Americans really struggle with this question. We do not get very high rates of success on the bond interest rates association, that there's an inverse relationship there. Question 4, we do a little bit better as a country because most Americans are comfortable with mortgage markets. So a 15-year mortgage typically requires higher monthly payments than a 30-year mortgage, where the total interest paid over the life of the loan will be less. So a majority of Americans are able to say, yes, that is a true statement, that if I get the 15-year, I'm going to pay a higher monthly payment, but I'm not going to pay as much interest because of the time. And question 5, we get back into a little bit more, again, product knowledge that people are less comfortable with, the notion of diversification. So buying a single company stock usually provides a safer return than a stock mutual fund. And many people get this question incorrect and are not comfortable with this concept of what it means to diversify an account. So that's just our financial knowledge. Subjective knowledge is also included in this data survey. So we have a single item measure, and this is maybe a little bit crude because it's only a single item, but it does give us a rundown of a scale of 1 to 7, where 1 means low and 7 means high. How would you assess your overall financial knowledge? So if people are able to kind of self-identify where they are on this scale. How smart are you in terms of personal finance? How comfortable are you with personal finance? And this is akin to our confidence measure, right? This is how confident consumers are in their ability to make decisions. So what we did, and based on some work that was being done by other scholars, is we took these 2 different knowledge concepts and kind of worked to combine them into a measure of potentially financial capability. this notion that we could have 4 mutually exclusive knowledge categories that combines subjective and objective components. So people can be high scoring in both categories. So they can have high objective and high subjective knowledge. They can be very good in their objective knowledge, but also low in their subjective knowledge. Or they can be poor in their objective knowledge and very high in their subjective knowledge. Or they can be low in both categories, right? We did do the classification of high or low based on sample median values. So whether someone was considered to have a high objective knowledge score was simply based on whether they were higher than the median knowledge score for the whole sample. Same with the subjective knowledge. So that was how we classified individuals in these categories. But having these 4 categories gives us a little bit more to work with and to kind of compare them on. And what we're interested in doing was looking at borrowing behavior in alternative financial service markets. So here were the 5 different alternative financial services we looked at. We did explore these each in separate models, so we looked at each behavior distinctly, not just alternative financial services behavior as a whole. We studied payday loans, rent-to-own financing, title loans, tax refund anticipation loans, and the utilization of pawn shops. So all of these are quick ways to access resources for consumers, but do have relatively high costs associated with them. Now the difficulty here is that the variance in cost is quite extreme in the United States. So if you look at alternative financial services, it's hard for me to define for you what the cost of those services is because each state has its own separate regulation of these services. So if you go to some states, there's almost no lending of this form, or it's very, it's not that high cost. And in other states, it's enormous, the cost associated with these different lending instruments. So it's hard to say exactly what you're dealing with. We also wanted to try to capture this notion that do people need these alternative financial services? And so we tried to control for this notion of what might drive us to need these resources of capital. And so we could control for the thing of we could control for a lot of these variables in this data set. Do people currently have an emergency fund to fall back on? So if you have an emergency fund, the logic should be that why would you run to a payday lender in the event that you need quick cash? You shouldn't need that. That's the point of the emergency fund. If you haven't had any income shocks in the past 12 months, if you're a homeowner, having health insurance, having a checking or saving account, reporting no difficulty paying bills, having a high credit score suggesting alternative lending options might be available to you, and the existence or non-existence of medical or student loan related debt. So these are not going to be perfect by any means, but by looking at these as a series of controls might give us a better signal of whether someone really needs to rely on some outside funding sources, such as an alternative financial service. So we ran 5 separate logistic regression analyses. Basically, yes, if they report utilization of each of these financial services in the past 5 years. And this timing was a big limitation of the study, I felt like. It was one of the weird things about this survey, that they essentially have all kinds of present information on knowledge and behavior, and then alternative financial services encompasses the past 5 years, which really gets kind of difficult. It makes things a little bit messy. But we did run a separate analysis for each, basically each of these objective need controls. So we ran separate analyses, and we controlled for lots of other things. So I'm just going to throw this out here, because if I try to put the tables up here, it's just nonsense, so we're going to kind of give you a quick overview. Age, gender, ethnicity, education level, marital status, number of children, labor force participation, income, insurance ownerships, banking status, emergency fund, difficulty bill management, income shock, and risk attitude. You can kind of recognize that a lot of these later ones are controls for need. So let's look at the results in a broad sense. We found that objective knowledge was consistently associated with decreased likelihood of AFS use. So if we just looked at objective knowledge purely, there's a sense that, okay, this is at least associated, and it's positively associated with the notion that the more you know, the less likely you are to employ these instruments in your daily finances, or at least at some point. Subjective knowledge was somewhat positively associated with a few of them. Now these results aren't really thrilling ones. The thrilling ones are when we kind of combine the measure and get into the stuff of, well, what happens if we really look at how people behave with this new knowledge measure? And here we use the low as our reference. So the low objective, low subjective is our reference. Both of those with high objective knowledge, so high objective, high subjective, low subjective, are reporting less likelihood of AFS use. The critical finding was that the low objective, high subjective, these are our consumers that are quite confident in their knowledge, but actually have very low actual knowledge, so these potentially overconfident consumers are much more likely to be employing these services. So we started to kind of say, well, this might be the thread that we're looking at. And this pattern was identical across each of the AFS behaviors. So this is just payday loans, but for all the other types of services, we saw the same general pattern. Now the magnitudes varied, but we saw the same consistent message that these overconfident, lower objective knowledge, high subjective knowledge consumers were engaging in these practices. And if you really look at it for controlling objective need, it gets even stronger. So if we look at this one, and sorry these slides are kind of messy, that's why I only threw one of them in here. This is again our low objective, high subjective. The magnitude has gone up greatly. So we have 112% greater likelihood among this category, where it was 37% when we weren't controlling for objective need. So controlling for whether they actually need these products, we now see overconfidence even more, is an even stronger factor in predicting these outcomes. So really quick kind of sum up is I think in working with consumers and starting to think about how consumers interface with markets, we really have to be mindful about how consumers are aligning their objective and subjective knowledge. So do they really have a good understanding of their knowledge? If they aren't that knowledgeable, do they know it? If they are knowledgeable, are they confident about it? Do they know that? Because I think it's just as important to not be underconfident as it is to potentially avoid overconfidence. I think knowledge is very limited in what we can ask it to do. We have to look more at making markets, I think, more creatively. We have to talk about how can markets work with consumers rather than focusing on, well, what do they just need to know in order to operate markets? I think markets have to adjust some, and we'll look at that, I think, probably during this conference a little bit. But that's a quick rundown, and we can have the discussion. If you have questions for me, here's my contact information. I'm happy to talk anytime about it, and I have cards and things like that. So, thank you.
Thank you, Professor Robb. It was a very informative presentation. The discussant of this paper will be Professor Hong Lee from Waseda University.
It's the greatest honor to discuss in this forum. They say that Japanese start his presentation, his or her presentation with apology. But Americans start his presentation with joking. I'm not Japanese, but I have to start with my apology. Actually, I received the presentation data last night, so every time to prepare my documentation. So I have to talk without documentation. Professor Robb's research is very interesting and suggestive for us. Especially, he pointed that subjective knowledge is not good, in a sense, in this case. That's very suggestive. Otherwise, we know that some people do not have the full information or full knowledge about the financial instruments. So they don't rational consume for the financial instruments. actually, in Japan, many people make suicide because they cannot pay off their debt with high interest rate. So Japan's government made the law of interest limitation as well as in Korea. And Japan's government also lowered the interest limitation several times, which is now varying from 15% to 20%. I didn't know about whether the American there is a similar law in America also, and I wanted to know what the Professor Robb think of the effectiveness of the regulation or interest rate limitation. That's my question. Thank you.
Okay, we have two very interesting papers, totally different topics and from different countries. But the cost of having those interesting papers was mismanagement of time on my part. So it's almost time. We are running out of time. But we still, I can tax several minutes of your break, 20-minute break, to entertain a couple of questions from the floor. So don't hesitate if you have any question. I will convey your question to the presenters and discussants. Any question? Yes. Professor Tennyson.
Hi.
We have only one mic, so I will just...
Thank you both for very interesting presentations. My question is about the first presentation. I'm curious to learn a little bit more about what is the pilot project for the non-recourse loans in Korea. So there's a pilot project starting in December. Is it just they may be structured in this way, or certain types of loans or markets will have that feature?
Pilot means that yes, actually, so pilot non-recourse program means that we are not going to make a non-recourse mortgage for regular lender. So it's only for very limited number of consumers. So we say national housing fund, the consumers, so those people is the low income and
separate regulation of these services. So if you go to some states, there's almost no lending of this form, or it's very, it's not that high cost. And in other states, it's enormous, the cost associated with these different lending instruments. So it's hard to say exactly what you're dealing with. We also wanted to try to capture this notion that do people need these alternative financial services? And so we tried to control for this notion of what might drive us to need these resources of capital. And so we could control for the thing of we could control for a lot of these variables in this data set. Do people currently have an emergency fund to fall back on? So if you have an emergency fund, the logic should be that why would you run to a payday lender in the event that you need quick cash? You shouldn't need that. That's the point of the emergency fund. If you haven't had any income shocks in the past 12 months, if you're a homeowner, having health insurance, having a checking or saving account, reporting no difficulty paying bills, having a high credit score suggesting alternative lending options might be available to you, and the existence or non-existence of medical or student loan related debt. So these are not going to be perfect by any means, but by looking at these as a series of controls might give us a better signal of whether some really needs to rely on some outside funding sources, such as an alternative financial service. So we ran 5 separate logistic regression analyses. Basically, yes, if they report utilization of each of these financial services in the past 5 years. And this timing was a big limitation of the study, I felt like. It was one of the weird things about this survey, that they essentially have all kinds of present information on knowledge and behavior, and then alternative financial services encompasses the past 5 years, which really gets kind of difficult. It makes things a little bit messy. But we did run a separate analysis for each, basically each of these objective need controls. So we ran separate analyses, and we controlled for lots of other things. So I'm just going to throw this out here, because if I try to put the tables up here, it's just nonsense. So we're going to kind of give you a quick overview. Age, gender, ethnicity, education level, marital status, number of children, labor force participation, income, insurance ownerships, banking status, emergency fund, difficulty bill management, income shock, and risk attitude. You can kind of recognize that a lot of these later ones are controls for need. So let's look at the results in a broad sense. We found that objective knowledge was consistently associated with decreased likelihood of AFS use. So if we just looked at objective knowledge purely, there's a sense that, okay, this is at least associated, and it's positively associated with the notion that the more you know, the less likely you are to employ these instruments in your daily finances, or at least at some point. Subjective knowledge was somewhat positively associated with a few of them. Now these results aren't really thrilling ones. The thrilling ones are when we kind of combine the measure and get into the stuff of, well, what happens if we really look at how people behave with this new knowledge measure? And here we use the low as our reference. So the low objective, low subjective is our reference. Both of those with high objective knowledge, so high objective, high subjective, low subjective, are reporting less likelihood of AFS use. The critical finding was that the low objective, high subjective, these are our consumers that are quite confident in their knowledge, but actually have very low actual knowledge. So these potentially overconfident consumers are much more likely to be employing these services. So we started to kind of say, well, this might be the thread that we're looking at. And this pattern was identical across each of the AFS behaviors. So this is just payday loans, but for all the other types of services, we saw the same general pattern. Now the magnitudes varied, but we saw the same consistent message that these overconfident, lower objective knowledge, high subjective knowledge consumers were engaging in these practices. And if you really look at it for controlling objective need, it gets even stronger. So if we look at this one, and sorry, these slides are kind of messy, that's why I only threw one of them in here. This is again our low objective, high subjective. The magnitude has gone up greatly. So we have 112% greater likelihood among this category, where it was 37% when we weren't controlling for objective need. So controlling for whether they actually need these products, we now see overconfidence even more, is an even stronger factor in predicting these outcomes. So really quick kind of sum up is, I think in working with consumers and starting to think about how consumers interface with markets, we really have to be mindful about how consumers are aligning their objective and subjective knowledge. So do they really have a good understanding of their knowledge? If they aren't that knowledgeable, do they know it? If they are knowledgeable, are they confident about it? Do they know that? Because I think it's just as important to not be underconfident as it is to potentially avoid overconfidence. I think knowledge is very limited in what we can ask it to do. We have to look more at making markets, I think, more creatively. We have to talk about how can markets work with consumers rather than focusing on, well, what do they just need to know in order to operate markets? I think markets have to adjust some, and we'll look at that, I think, probably during this conference a little bit. But that's the quick rundown, and we can have the discussion. If you have questions for me, here's my contact information. I'm happy to talk anytime about it, and I have cards and things like that. So, thank you.
Thank you, Professor Robb. It was a very informative presentation. The discussant of this paper will be Professor Hong Lee from Waseda University.
It's the greatest honor to discuss in this forum. They say that Japanese start presentation, his or her presentation with approach. But Americans start his presentation with joking. I'm not Japanese, but I have to start with my approach. Actually, I received the presentation data last night, so every time I prepare my documentation. So I have to talk without documentation. Professor Robb's research is very interesting and suggestive for us. Especially, he pointed that subjective knowledge is not good. In a sense, risky. That's very suggestive. Otherwise, we know that some people do not have the full information or full knowledge about the financial instruments. So they don't rational consume for the financial instruments. Actually, in Japan, many people make suicide because they cannot pay off their debt with high interest rate. So Japan's government made the law of interest limitation as well as in Korea. And Japan's government also wrote the interest limitation several times, which is now varying from 15% to 20%. I didn't know about whether the American there is a similar law in America also, and I wanted to know what the Professor Robb think of the effectiveness of the regulation or interest rate limitation. That's my question. Thank you.
Okay, we have two very interesting papers, totally different topics and from different countries. But the cost of having those interesting papers was mismanagement of time on my part. So it's almost time. We are running out of time. But we still, I can tax several minutes of your break, 20-minute break, to entertain a couple of questions from the floor. So don't hesitate. If you have any question, I will convey your question to the presenters and discussants. Any question? Yes. Professor Tennessee.
Hi.
We have only one mic, so I'll just...
Thank you both for very interesting presentations. My question is about the first presentation. I'm curious to learn a little bit more about what is the pilot project for the non-recourse loans in Korea. So there's a pilot project starting in December. Is it just they may be structured in this way, or certain types of loans or markets will have that feature?
Pilot means that yes, actually, so pilot non-recourse program means that we are not going to make non-recourse mortgage for regular lender. So it's only for very limited number of consumers. So we say national housing fund, the consumers, so those people is the kind of low income and limited the number of consumers. So that's why we can.
So it's limited to the national housing fund.
Yeah, exactly.
Okay, great.
So it's
Thanks.
like the FHA program in the US. Any other question? Yeah.
Thanks. It's Professor Robb. It's basically regarding the methodology. Sometimes I found you have used a 7-point Likert scale for knowledge, and sometimes you use the 5-point. Now, especially the 7-point one, don't you think it's a little difficult to differentiate those? I mean, this 7, I don't know why you have used that.
Yeah, I can help, yeah. I use that in the 7-point one because they made me, because that's what's in the data set, unfortunately. And I think you're correct. The first ones that were 5-point were data that I collected myself, and so I used the 5-point Likert type scale for those kind of attitudes for college students. When I was dealing with the AFS products, that was a large national data set, and so they had chosen to use this 7-point financial satisfaction scale. I'm not sure exactly what the logic was, because when you get down to it, yeah, refining those differences could be somewhat arguable. But we did use that scale, I think, as effectively as we could. But it's sometimes just a limitation of what data is available.
A little one, I mean, regarding this, it's a 7-point or 5-point, it's a categorical data. Then you have used them for regression.
Yeah.
But normally regression, we use the metric type of data. So what's your assumption on that?
It was multinomial, so in terms of the scaling for the multinomial, we did create categorical responses. So we basically took, in terms of like the knowledge, the high, medium, low, and so that way you can have multiple categories beyond 2. So it's kind of like taking logistic and bumping it up with, it allows you to have multiple categories in reference. It allows you to kind of operate effectively with those kinds of data. You can also cross-reference it with OLS sometimes to kind of check robustness, and we did several robustness checks on the data analysis itself. Probit could have also been employed. We did look at Probit analysis as an alternative, and that was essentially identical. And so it was just a choice of which one do you want to report and interpret, even though technically different methods could have given you the same results.
Okay, just one more question, if there is a burning question. 3, 2, 1. We are done. Thank you very much.
Thank you, sir.
Thank you. Very interesting. Sorry about pushing you in terms of